Good afternoon, ladies and gentlemen. Thank you for joining this UNDP session that will focus on investing for change in Africa. We will start with short opening remarks from Saba Sobhani, Director, UNDP Istanbul International Center for Private Sector in Development. Saba.
Thank you very much. Excellency Minister Zainab Shamshuna Ahmed, welcome. Distinguished panelists, both in the room and online. Karen Wilson, our moderators, ladies and gentlemen. I'm Saba Sobhani, a director at UNDP, and I'm very pleased to welcome you to this panel discussion about investing for change in Africa. UNDP and its partner in this event, Alpha Mundi, and the SDG Lab wanted to put the spotlight in the African continent to underscore its diversity, tremendous potential, and dynamism, and discuss how government, domestic and international actors in the enterprise and financial sector and the international community at large can better work together to realize African potential for sustainable development. Africa is a continent of wealth with abundant natural resources ranging from arable land to fisheries and forests to mineral resources. The African Continental Free Trade Area, AFCFTA, that entered into force in 2021 will position Africa as an important production and trading bloc. Intra-Africa trade is expected to increase by 25% by 2040 and trigger an estimated 6.7 trillion in consumer and business spending. The continent's working population is expected to increase by 20 million each year to 2030, providing the human capital necessary to underpin socio-economic development. But Africa is a continent of contrast. Inequality is rising. 10 out of the 19 most unequal countries in the world are in Africa. While many countries in the region recorded high and sustainable growth over the last decades, such growth has been jobless, with women and youth falling behind for lack of opportunities. While the rapid urbanization spreading throughout the region provides opportunities for social and economic transformation, it can lead to large segments of the population living in slums in African cities if not managed properly. Africa is also highly vulnerable to climate change. Available data indicates part of the continent will be hotter and arid and others prone to flooding and affected by rising sea levels. Inadequate investment in building resilience, strengthening adaptation, and risk mitigation threaten to undermine the sustainability of development gains. The COVID-19 pandemic and the global cost of living crisis has led to human development reversal around the world, including in Africa. For the second year in a row, the Human Development Index that we at UNDP are proud to host the Secretariat fell in 2021 after 3 decades of steady improvements in standards of living, access to education, and life expectancy. In situations such as these, we need more and no less investment in sustainable development. However, many countries in Africa find themselves at a crossroad with increasing financing needs to protect the poor and vulnerable from the impact of compounded crises and continuing investing in the SDGs. But we constrain public finances, constrained by debt and lack of fiscal space. Domestic and international private investment has an important role to play in addressing these developing needs while seizing the many business opportunities in the continent. And we will have more discussions on this. There's a number of the investments that have been discussed during the day today and yesterday in Africa and the potential in energy transition and other, but there's a long way to go for private finance to reach its potential in Africa. The continent attracts 5% of global FDI of $83 billion in 2021, and investment go predominantly to natural resources and extractive industry in a few countries. On the other hand, nearly half of global impact capital goes to Africa to sectors such as health, fintech, and renewable energy. These investments are financing incredibly innovative ventures all over the region. What can be done then to mobilize more private capital to Africa and direct that capital towards investment with purpose at scale, accelerating the trends seen in impact investment in the region? What can different actors at the local and international level do to channel more and better capital to all of Africa for people meeting their aspiration in a sustainable planet? UNDP, the United Nations Development Program, is working with many different actors across the UN, international financial institutions, governments, corporates, and financial sector in Africa to help align and mobilize additional public and private finance to the SDGs. We do this, for example, by providing public goods such as market intelligence for investors through the SDG investor maps in specific countries and identifying enterprises operating in those areas with impact for society, the economy, and environment. Or we build up capacity of governments and other stakeholders to formulate integrated financing strategy with articulate all sorts of development financing so they can pull together towards limiting risk and filling gaps in achieving the SDGs. The INFF strategy further identifies needed reforms across public and private capital to de-risk investment and effectively leverage the right kind of capital. I look forward to the panel and discussion with all of you, and look forward to concrete partnerships that will help us bring a change in finance to realize the SDGs in Africa. Thank you very much.
Thanks, Abbas Obani, for these opening remarks. Let me invite now Tim Raji, who is the founder and the managing partner of Alpha Mundi Group. Tim.
Good afternoon. It's a pleasure to be here. My thanks to Sustainable Finance Geneva for bringing us all together during Building Bridges, and to the UNDP for organizing this session on Africa. It's a pleasure to see such stellar panelists. They have a lot of wonderful insights to share, so I'll keep my remarks short. My company, Alpha Mundi Group, has been investing for a decade now in sub-Saharan Africa. We began by providing loans to small and medium enterprises, and then we moved to mezzanine finance and minority equity stakes. And through our foundation, the Alpha Mundi Foundation, whose director is based in Kenya, Lade Arabe, we have also provided grants to SMEs. These grants have helped SMEs provide loan guarantees to third-party lenders, and they have also helped finance innovation for gender empowerment and products and services development. So I have to say that, when you hear about Africa, sometimes there is a perception mostly of high risk. But in finance, you cannot achieve high returns without a certain level of risk. And if you have boots on the ground like we do, and you can follow and commit to small and medium enterprises for the mid to long term, you can really mitigate these risks through a proactive fiduciary risk management and achieve the returns that we're starting to see now across Africa. It's been interesting to witness over the last decade the emergence of a secondary market. When we first invested in SMEs in Africa, it was very difficult to imagine or understand what exit opportunities we would have down the line within 5, 7, 9 years. But today we can see a lot of mainstream private equity investors from Europe and the US, as well as from Africa, looking for the deals that are emerging. And Twiga Foods, for example, is one of our portfolio companies. Peter Njonjo is its co-founder, and they've done so well in Kenya to address the issue of food insecurity. And like Twiga Foods, we're seeing a lot of companies now go beyond their home market and expand across borders to become Pan-African market leaders. And this creates the possibility for African unicorns that initially were maybe social businesses or impact enterprises, and that are solving a very specific issue related to the SDGs, but doing so in a commercial fashion. And once you've solved the issue of how to get your funding, how to address the policies that vary from market to market, and then can have some degree of volatility still in Africa. And once you solve the issue of getting to the end consumer, and these are three equations that are not easy to solve, but in the case of companies like Twiga, they have been able to do so, then there is really no limit to how fast or how far you can grow. And that's what really Alpha Mundi is about. I'd like to say that most impact fund managers operating in Africa today, and there's an increasing number of them, are about bringing to scale solutions to the Sustainable Development Goals, in particular in the SME segment. I must say that I've also very much enjoyed the continuum of capital that we've played around with, from grants with our partners at USAID and at CEDA, at the German Development Agency, and investments. You might be surprised to hear that among the investors who finance our activities in Africa, we have a Swiss pension fund, we have a Dutch bank. So you have really mainstream investors who've now understood the opportunity set that Africa marks. I'll just finish with one last comment related to the pandemic. It was a very rough time for the world as a whole, but for Africans in particular. They were among the last to receive the necessary vaccines, and they had experiences of long shutdowns in multiple countries. And it's fantastic to see the resilience of entrepreneurial talents in Africa through these challenging times, maybe because they were already resilient before the pandemic even began. So I will leave you to the panel conversation, and my thanks again to Sustainable Finance Geneva and UNDP for making this possible. Thank you.
Thank you, Tim. I'm going to leave you in 1 second in the very good hands of Karen Wilson, who is one of our most talented and seasoned experts on entrepreneurship and finance. But I also wanted to let you know that we're fortunate enough to have Dr. Sarah Alade, who is the special advisor to the President on Finance and Economy in Nigeria, in the room. And we're trying to bring together the local ecosystem from Geneva and countries like Nigeria or Tanzania. So if you have an interest in investing in Africa and more specifically in Nigeria, please get in touch with UNDP. Thank you.
Thank you, Sarah. Good afternoon, everyone. It's really a pleasure to be here with you all. And I'm greatly appreciative to the co-organizers of this session, and particularly to UNDP. UNDP started a smaller version of this event back in 2016, and they very kindly have invited me to moderate at their plenary session every year. I really appreciate that. And of course, in 2018, what started as a smaller initiative has really bloomed into Building Bridges Week, and it's really just incredible. I mean, those of you that were here with us the last couple of days, it was great to have everyone here for the summit, and of course, we're going to have hundreds and hundreds of people here over the next couple of days for these really exciting discussions. But thanks again. I just wanted to acknowledge UNDP for helping get Geneva on the pathway to where we are today, and also for inviting me here. I really appreciate that. So we talked a lot yesterday, and we also heard earlier today in the discussion about many of the challenges that we're facing globally. So certainly don't need to repeat that. But what I did want to say, this session is not about that. This session is about opportunity. And there are so many opportunities to invest in Africa. I've had the honor and the privilege over my career to have different opportunities to work with enterprises and officials across Africa. Most recently at Oxford, where we do an annual entrepreneurship roundtable. And we did one focused on high-growth entrepreneurship in Africa. This was last year. It was virtual. And it was just incredible to see how much has changed, how much growth there is, how much opportunity in fintech and many other areas, solar, how the ecosystem has developed across Africa and countries across Africa. So certainly there's a lot of opportunity, and I look forward to hearing from our two entrepreneurial experts here and financing experts. And also, of course, we're very honored to have with us the minister. They made me sit on this side, but then I can't see you, actually. Can I switch again? Oh, there, okay. So we have a lot of really important issues to discuss. And, one of them is yesterday we also heard a lot about funding. And financing the SDGs, we need more funding. The shortfall is over $4 trillion, and that's just for developing countries. And we also heard that actual FDI flows are going down, so there is a big issue. But I just wanted to reinforce, it's not just about the money. And to be honest, that's what gets me so excited about what's happening in Africa today. It's about innovation. How do you do things differently? Because to be honest, if we're just going to throw more money, we heard some of this yesterday, well, you know, there's lots of money and we throw money, and that's not what this is about. It's about how do you invest in innovation and opportunities that are more effective and more efficient so we can have change. This is about investing for change, and change is about innovation. So again, I'm really excited about the discussion we're going to have. We also heard yesterday, and we'll be talking more today, about the role that government can play. Obviously, there's a very important role that government can play in the ecosystem. But also, very importantly, are partnerships. Partnerships between government, investors, companies, civil society. And it's really about the partnerships. It's not about sitting back and waiting for the government to move before investors will come in. We heard a little bit of that yesterday, much to our dismay. Everyone needs to step up. It's everyone's job. We need to work together if we're really going to be serious about investing for change and investing for the SDGs. So with that, let me introduce the panel. We have Shamsuma Ahmed. She's the Minister of Finance from Nigeria. Thank you so much for being here with us. We know how busy you are, and we're really honored that you're here with us today. Unfortunately, Franny could not join us, but that gives more time for the three of us to have a nice discussion here. On my right, we have Peter Jeanjot, who's the CEO of Twiga Foods, a very experienced and renowned entrepreneur from Kenya, but you're also very active in Nigeria and I think across the continent. And then we have Muthoni Wachira. She's the Chief of Staff at MarketForce, expert in venture capital and involved in many initiatives and efforts across Africa. And you're based in Kenya. Yeah. So with that, we want to have a very interactive discussion. Unfortunately, we don't have Slido because I thought that was great, where you could send in your questions. But be thinking about your questions. I have plenty, so I can keep them going for quite a while. But we're going to have each person speak a little bit, and then I'll have a Q&A with them, and then we'll open up to the audience. So I'm looking forward to that. But first, Minister, I wanted to start with you. Obviously, with the COVID pandemic and the war in Ukraine has exacerbated many of the constraints for financing in developing countries, as we've heard, and Nigeria is not an exception. However, Nigeria has been working on the Integrated National Financing Framework. I believe you've been playing a leading role in that, and there's been certainly a lot of progress made. And I also know that Nigeria is one of the real entrepreneurial hubs in Africa, and there's really a lot happening, and we would love to hear from you about some of the developments. Please.
Thank the UNDP. Let me join you to thank the UNDP and the organizers of this forum, and also listen to what you said. Money is not everything, no. Partnerships at this point is very, very important. And that's why from the beginning, we in Nigeria, in implementing the SDGs, decided to make sure that the SDGs is mainstreamed into all government plans, programs, and projects. We started by early domestication and integration, even right up to our subnational levels. We have put in place an interagency coordination framework, an institutional framework that enables us to even bring in the private sector as well as development partners in our implementation of the SDGs. Again, partnership is important. So in order for us to mainstream the SDGs into our policies, we started by having our National Bureau of Statistics with the SDGs office to develop a baseline indicator to enable us monitor and track our performance. And additionally, also, we very quickly rolled out a tailor-made integrated sustainable development goals to the ISDN, which is one of the tools that the UN system has offered for data analysis and modeling. And we have developed that and is domesticated for Nigeria. But even with the progress that we have made so far, our analysis and data and modeling shows that we still have a huge financing gap of 100 billion US dollars, which we need to cover over the next 10 years. And that's 10 billion US dollars for Nigeria per annum. We're working proactively to close this financing gap, in part through ongoing reforms aimed at enabling and improving the business environment, creating the right fiscal space for investments, as well as supporting various efforts designed at diversifying our economy away from oil and gas. Some of these efforts include strategic revenue growth initiatives, as well as the annual finance acts that have now become a tradition that helps us to amend fiscal laws that enables businesses. We have reforms also under the Presidential Enabling Environment Council. We have extensive private sector engagement. We're also scaling up our national social investment programs, deepening interventions that are specifically at the intersection of gender and fiscal policy, because it's important that as we grow and we enable business, that we're making sure that the women and our youths and the vulnerable are not left behind in the growth process. And further on, like you mentioned, Karen, we have been working very hard at the integrated national financing framework. Nigeria is one of the pioneer countries. We just launched the Nigeria INFF at the sidelines of UNGA. And this INFF includes a financing strategy that is underpinned by a revenue strategy as well as medium-term expenditure strategy. The goal of the strategy is to identify different innovative financing sources that will help us to build coherence by aligning policies as well as regulatory frameworks with instruments that will enable business to reach optimum performance. And also, it is helping us to establish sequenced actions to financing national development and strategies, along with policies that are aligned with our own priorities. This financial strategy has 4 key areas that we have identified, and this includes domestic public finance, domestic private finance, international public finance, as well as international private finance. Again, I want to emphasize that partnership is very important. Government has very limited fiscal space. Our national plans has projected that while government investment is just 15%, 85% of investments to grow our economy to the level we desire is going to have to come from businesses and the private sector. So we have to do everything that we need to do to enable businesses and investments to thrive in Nigeria. I'd like to stop here, Karen, and hand over to you.
Great. Thank you so much. Maybe just a follow-up question? Okay, I lost you for a second. So how, I guess these plans have just been launched recently, but could you give some thoughts about implementation and how things are going so far and where you might see some of the opportunities and challenges?
Well, the INFF is what is just launched now, but we have our national plans. We have a 5-year medium-term plan. We also are working on a long-term plan, a 25-year Nigeria Agenda 2050. We have annual, medium-term, and medium revenue frameworks that are implemented rigorously. What we see in these plans is the opportunity that the plans are showing for investments by the private sector in so many areas, including education and health, but also information technology and fintech. The fintech industry in Nigeria is booming. Today, of the unicorns that are in Africa, the 5 leading ones are from Nigeria. We have a very large youth population that are very entrepreneurial. We have made sure that we made conscious fiscal policies to encourage investments in the power sector, in the information and technology sector, as well as in financial services. The Nigerian financial services industry is one of the major exports we have today. In Nigeria, Nigerian banks are doing well across the African sub-region today, and they continue to grow. The last GDP reports that we released, Q2 2022, we had a growth of 3.54%, and 22% contribution of that growth is from the financial services sector. So there's a lot of opportunities for investment in financial services, in information and technology services, in the agricultural sector, because we're moving to agribusiness, and there are so many incentives that have been provided for the agricultural sector, for the oil and gas sector, as well as different categories of manufacturing.
Great. Thank you so much, Minister. That's a very good transition to you, Peter. Your company, Twiga Foods, has been leveraging technology for growth. So question for you in terms of how have you financed that growth, and what have been some of the challenges and opportunities in the financing along the different stages of development of the company? Thank you.
Thank you so much, Karen. So, and it's an honor being here, and I want to thank the organizers for having us come and share our story. So when I look at raising money for a business in Africa, the hardest part is the starting part. It's not easy. So when I look at what it is that we had to do as an entrepreneur, I had to, my wife and I, we had to sell our matrimonial home just to get the capital to invest in the business. And that gets a business to a point where it's bankable, or you can present it to investors in a model that they can then discern and understand. So, but when I look at raising capital for a company sitting in Africa, Africa has a narrative that's not very wholesome. So when you look at what you find in the media, sometimes, poor governance, mismanagement, corruption, all these things start creating a challenge in the minds of investors in terms of what risk am I taking on when I get into some of these opportunities. So for we as entrepreneurs, we have to work extra hard in building a level of governance that is extremely high, that can stand scrutiny on at any level globally. And that's really important, so that somebody putting their money in the company can then have that peace of mind that my capital is safe. And the people that have entrusted this capital are then able to execute. When I look at, say, for example, when we were having Goldman Sachs invest in us during our Series B, we had to undergo the FCPA audit, Foreign Corrupt Practices Act. And there was no invoice that was not audited. And the key thing is that, we came out clean. And that starts giving people a lot of comfort in terms of what it is that we're doing out there. So one thing I found that to be very, very important is have a clear strategy and a clear vision. Ensure that the people who are then investing in that business in a very simple way understand the problem that you're trying to solve and how you're going to go about it. The second thing is that have a team with the credibility that they can then execute against that opportunity. That is very, very important. And then the third thing, show that you're able to execute against what it is that you're saying. And that has helped us in terms of raising capital. So, and what I would say is that, there's of course huge opportunities that across a continent, but I think the key thing is that for me, being an entrepreneur is around how I've balanced those opportunities and the risks in creating comfort that can then attract the money that we've been able to raise.
Thank you, Peter. As I mentioned in the opening, the ecosystems across Africa have really developed in the last 5-10 years, incubators, accelerators, and can you talk a bit about how you see the landscape across Africa? I know there's sort of regional hubs and there's a lot of activity in certain countries and in certain regions, but can you talk a bit about what you've seen over the last 5-10 years?
Thank you so much. I think what I've seen over the last 5 to 10 years, actually, there's been a significant growth in terms of funds that have decided to invest in the continent or even set up shop on the continent. I remember the first time we started raising money. We founded Twigger in 2014. And I came from Coca-Cola. I worked in Coca-Cola for over 20 years. And my last assignment was in Nigeria, so at least got to move around the continent and really understand how the continent operates. And when I look at back at 2014, you know, when we received our first venture capital term sheet, I didn't know half the terms that were on that term sheet. And actually, I went to YouTube on the Y Combinator channel just to understand, you know, what is this thing that they've put out there, you know, pre-money, post-money. And it was quite interesting getting into that new world. When I look at today, we did, I think, the first convertible note in East Africa. So, and when you look at that type of environment, it was kind of very pioneering. But when I look at today, credibility of companies like ourselves is giving investors more and more confidence to then come onto the continent and say, by the way, I think they're credible funders who actually we can back on the continent. And as a result of that, you've seen that if you look at last year, I think there was over close to $5 billion that was invested in the African continent. And of course, there were like a couple of markets that were leading that. I think between Egypt, Nigeria, Kenya, and South Africa, that was bulk of investment. And I think a lot of that is coming from entrepreneurs who've really built credible businesses, but more so are also involved in creating an ecosystem. You know, the Honorable Minister mentioned some of the unicorns that you have in Nigeria. You know, for example, GB or Flutterwave, you know, is also very, very active in backing up startups. And the key thing is that a lot of us now are also doing a lot of angel investing, which is giving some of these young entrepreneurs also the leg to get in and raise more capital. So I think the key thing is that there's been a lot of growth in the last 8 years, and I'm hoping that the current turbulence that we're seeing in the market can essentially pass on, and we should then see more of this growth in the next couple of years.
Terrific, and the point about serial entrepreneurs is so important. That's really how the Silicon Valley developed. It was some entrepreneurs that were successful, they got venture capital, then they moved out of the company and they created other startups. So it really creates this whole ecosystem, also of angel investors, et cetera. As you said, we're seeing that in Europe, and it's great to see that happening across Africa. Also, as we heard from the Honorable Minister, there are many unicorns now across Africa, which is really, really exciting. So, Muthoni, we were talking a bit about venture capital. It's a good time to come to you. Can you talk a bit about venture capital investment in Africa and what you've seen over these last years and how the market is developing?
Thank you, Karen, and thank you for the organizers for having me here. So venture capital, I got into venture capital 2016, 2015, so it's been a few years now. And initially, there was a lot of funding going to the very early stages. We'd get tickets of $10,000, $50,000. That was the ticket range. And it took companies maybe 18 to 24 months to raise from one round to the next. Currently at Market Force, which is, I want to say we are on the unicorn track. We've been around for 4 years. and we've raised 3 rounds in that 4 years. Our last round was 40 million Series A. So we're seeing more capital going in faster into African enterprises, which is awesome. We're also seeing a recognition that African founders and women founders bring resilience, better revenue traction. They understand context. In Africa, you really have to have contextual understanding, otherwise you're taking unnecessary risk. There is the perception of risk, we've talked about this. There's also the burden or opportunity for governance. And so part of my role at MarketForce as Chief of Staff is to ensure that we have strong governance in place, which does not only allow for trust to be built with funders, but it also leads to sustainable profitability and strong investor relations. And so having those things in place, as Peter mentioned, it was quite a nascent space. It's maturing very quickly. We're seeing first-time fund managers coming up who are also African, which is exciting to see. We're seeing established funds bringing in Africans to principal and partner level roles, which is exciting to see. I'm a big believer that if you want to see change and you want to make decisions that are different from what we've seen in the past, I remember in 2017 in Kenya alone, 93% of capital used to go to expatriate founders. And we've seen progression away from that towards more indigenous founders and more women founders. And any change you want to see takes intentionality. I often say it takes intention to bring inclusion, and diversity is by design. And so seeing that from all the way from capital allocators to founders and what's happening on the ground from a customer perspective is really quite encouraging.
Thank you. That's exciting. Of course, I'm going to have a follow-up question. What about, obviously in markets like, in countries like Kenya, Nigeria, South Africa, there's been a lot of development on entrepreneurship and venture capital. You talked about the growth of local venture capital firms. Peter talked about local angel investors. What about outside of the main hubs? And even within the countries, there are differences between Nairobi and the rest of Kenya. So how can we make sure that entrepreneurs with great ideas can also get funding outside of these main hubs?
That's a good question. Before I reflect on that, I think the other thing that we're seeing and that I really would like to see more of is corporate venture capital. Corporates on the continent play a really big role. They understand the regulator, they have deep relationships, they've navigated structural challenges on the continent, and they bring more than money to the table. They bring their brand and credibility, they bring their network, they also address gaps in their innovation that they can get from startups. So I think there's definitely an opportunity for corporates to play a bigger role in the startup space than they are currently. When it comes to just outside the 4 main hubs, I know when you think about venture capital right now on the continent, there's the 4 giants. There's Egypt, South Africa, Nigeria, and Kenya, and those continue to dominate the VC space. I think currently we have about $1 billion already invested in the first half of this year in Kenyan startups. So there's a lot of money flowing to those 4 hubs. And specifically to the capital cities, or the top 2-tier cities in those countries. And so what I've seen is incubators and accelerators who are setting up outside of those cities. We've also seen grant funding flowing to organizations that are based outside of those capital cities. I think it is, it's hard to think you can scale across the continent without addressing those capital cities. They do tend to carry a large population. They have more developed infrastructure in place. The people that you're building a tech startup, for example, are more technologically savvy. So you will need to have presence there. At MarketForce, what we're saying is when we expand, we're currently in 5 countries right now. We went from 1 country to 5 countries in 2 years. And we have what we call a tier 2 expansion strategy, which means when we go into a country, we look to expand outside of the capital cities as soon as possible, because we recognize that also that is a market differentiator. And we are looking to address an access gap for 100 million informal merchants on the continent.
Great, thank you. Peter, did you want to add anything to that?
No, I think to actually accelerate a lot of the entrepreneurship that we're seeing, I think it's finding a way that we can channel more patient capital, early stage, to some of these smaller businesses. Because what you find is that once you start moving out of the cities, the reality is that access to capital becomes harder, and what you find is that those ecosystems are not as well developed when you move outside of the big four markets. So, and I think that's where there's a role around sustainable finance to then say that, look, if we have to achieve our SDG goals across the continent, then how do we then start getting riskier capital to some of these younger startups at an early age, allowing them further along on the maturity continuum to allow them to then access the capital that many of the other startups are able to access. So I think it's around seed capital going into some of these early stage frontier markets.
Terrific, thank you. That's a nice segue back to the Honourable Minister. How do we get more SDG financing to flow? You talked about the plan. Could you talk a little bit more about what the government foresees both domestically and internationally to bring in more public and private capital? Thank you.
Thank you, Karen. If I may just add to the last contribution that Peter made. I think also that we need to continue to look for tools that will help to de-risk lending to small businesses. Because as it is, at least in Nigeria, for small businesses, it's becoming very difficult for them to access financing. As startups, they don't have any assets to use as collateral. So we must look at having special de-risking instruments that will support this business. And we've done something in this line. We set up an agency that is called NIRSAL. It's set up to provide de-risking instruments, especially for small businesses and medium-sized businesses that are investing in the agricultural value chain. And it has helped businesses that would otherwise not have been able to access financing to access finance. We're also working on accelerating our domestic revenue mobilization, in part through the SRGI, as I mentioned earlier on, and also through a tool that we call Accelerating Revenue Mobilization Reforms. This is helping us to strengthen our institutions, amend laws that require and policies that are required to be amended. We have used some of these instruments to increase taxes, to also provide exemptions in some cases, and also introduced new income streams. For example, taxing the digital economy, which we didn't used to have, and then also enhancing and improving on tax administration itself. The business environment is evolving. And through innovative financing, such as the Road Infrastructure Tax Credit Scheme, that we designed to enable investors to invest in constructing key road corridors within the country, using their investment resources and recovering their investment through tax credits over a period of time. This has proven to be very popular. And using this instrument, we have been able to enable private sector to take part in major road construction in Nigeria. And we continue to issue the tax credits as they mature. We also are using the Sukuk bond, which is also a debt instrument, but it's in a way also it's an investment. It's allowing Nigerians and investors to invest again in road infrastructure, visible road infrastructure all across our country. Now you will see roads, signboards, large signboards that says this road is being built by Sukuk, and it's become very popular. Every time we go to the domestic capital market to raise Sukuk bonds, we end up with a large over subscription. The Nigerian Sovereign Investment Authority also has the Infrastructure Development Project Fund that is established they're investing in the transport sector, agriculture infrastructure, health infrastructure, as well as power and gas. And so far, they've been also be able to attract other sovereigns, investment authorities to invest alongside them, and also some development financial institutions have partnered with the NSIA to be able to invest. We set up also the Presidential Infrastructure Development Fund, still managed by the National Sovereign Investment Authority, which has also attracted other funds. And these are for 3 key projects that were very important for the country. It includes the Second Niger Bridge, the Abuja-Kaduna-Kano Highway, as well as the Lagos-Ibadan Expressway, and the East-West Road. This project has also seen investors coming in to partner with NSI and invest to build this project. We have opportunities in our National Development Plan as well as in our Energy Transition Plan that we're marketing to enable investors to choose what they come to invest in Nigeria.
Fantastic. Clearly a lot happening in Nigeria, a lot of progress, a lot of investment. What about some of the other countries across Africa? I mean, I'm not going to ask you to comment on them, but is there a lot of sharing and learning between countries? I mean, obviously, Nigeria is one of the front runners in terms of the kinds of policies and programs you put in place. Are there opportunities to share that with the other countries? I know a number of other countries have also been working on plans, but it's just incredible the wealth of knowledge and progress that you all have had. A big congratulations on that.
Well, if I may, there has been a number of investment forums, Africa investment forums, that have helped us to strengthen our partnership. Just a few weeks ago, there was this ICF organized by Egypt, which was held in Cairo, bringing African countries together and sharing experiences in different categories of investment, including also sharing what we hope to be the road path for achieving our energy transition plans, having some common Africa asks that we must bring up at COP27. But we also have this Africa Continental Free Trade Agreement, which Nigeria and several African countries have committed to. It is helping us to bridge the trade gaps that we have, enhancing the size of the African market, removing trade barriers so that we're able to trade more within the African continent as we had several limitations before. The AFCFTA has taken effect, and we're already beginning to see this trade across borders without limitations. The glitches that are still remaining are being worked through in partnership and in cooperation. We also have some major infrastructure that are being built across our countries. For example, we're building a rail line from Kano to Katsina across to Jibia in Niger Republic, linking a major rail line that is already existing in Niger Republic. That will ease transportation of goods and services between Nigeria and Niger. There are several road corridors between Nigeria and our neighboring countries that are also being developed together with our neighbors.
Fantastic. Thank you for that. Muthoni, I wanted to come back to you. This conference is about sustainable finance, investing for the SDGs. Could you talk a bit about what changes are needed from the public and private sector to encourage more capital to flow into startups, growth firms, and particularly those like Peter's that are really focused on SDGs in addition to being high growth firms? You can be both. A lot of people think there's a trade-off. There's not necessarily a trade-off.
There isn't a trade-off, I agree. I've had it said once that if you're doing business in Africa, you're in the social business space. If you think about market force, we have 4 SDGs that we track against: gender, no poverty, decent work and innovation and industrialization. So being a tech startup that's looking at the informal trade market, there's about 76% of those are female. And so we really do take intentionality on the gender front from a team perspective, but also from the customer perspective. I think about what could be done. I still see a gap. So overall, Africa, even with all the gains that we've seen in the VC space and private equity space, we're still an undercapitalized continent. We see this a lot post-Series B, but at all stages for women-owned enterprises and local founders. And so there's need for improvement there on just how much capital is flowing to the continent. What can be done from a public and a private sector perspective. So from the public sector perspective, I think it's a regulation issue. We've seen regulators take a long time to catch up with innovation on the continent, and sometimes it has come at an expense of those organizations. So the process of regulation needs to conduct in itself in a faster pace and not limit the innovation of startups. We also need to see higher rates of R&D spending on the continent if we are going to see long-term growth. From a private sector perspective, I mentioned this earlier on CVC, corporate venture capital. It's disheartening to see that apart from Jumia and Takealot, no African startup that's raised more than $100 million of venture capital counts an African corporate as one of its investors. And this is a real shame. It's a real shame because then we don't get to keep all of the returns from those investments on the continent, and we need to have a way of recycling gains. We see the recycling of gains, as Peter mentioned earlier, from founders who've been able to exit. I'm happy to see now that secondaries are being accepted at Series A, even pre-Series A, before you had to stay until there was a buyout or an IPO, which was too long. And so that's the reason we're seeing more confidence coming from angels. We're seeing more syndicates coming through. We're seeing founders reinvesting into the ecosystem, which is super encouraging.
Great. And Peter, how do you think about your impact to society and what the organization is doing, and how much is that a factor in terms of raising money from the investors that you've gotten money from? Maybe you could talk a little bit about the types of investors that you've had. You mentioned some names. You have some venture capital. You talked about some others, but yeah.
No, thank you so much. So when we started out, we had a lot of risky capital, mainly impact. And as we started moving along in our journey, we started attracting more of a commercial type of capital. So when I look at our cap table today, you have family offices playing a big role, and these are family offices who are active in business. You have PE funds or slash VC, a late stage. The likes of Goldman Sachs, and then from there you have the likes of IFC and other funds across the continent. And what you find is that, and this is one of the challenges that I have seen, especially when it comes to attracting investors, is that if an investor is coming from Western markets, they're also looking for pattern recognition. Other businesses are financed before, and am I seeing similar patterns in Africa? And what you find is that the difference between Africa and the rest of the world is infrastructure. There's a huge infrastructure deficit. So you might talk about an e-commerce business, but an e-commerce business in the West doesn't think about warehousing, doesn't think about logistics, because all those are available as services. There's so much capital that has gone into building that type of infrastructure that's not a challenge. But if you're sitting in some of these markets, this infrastructure does not exist. So the challenge that you find is that for many companies in, say, outside of Africa, you raise capital and you focus on how do you invest in the intellectual property that requires you to deliver a superior return. But in Africa, you have to then invest in that intellectual property, and then you also have to invest in creating an enabling environment for your company to thrive. So when you have that duality of challenge on the continent, sometimes investors coming in from some of its Western markets do not recognize that second bit, which is around creating an enabling environment for your business to survive because of an infrastructure deficit. So one thing that we have found is that it then becomes increasingly important being able to position that as a need that you need to meet in order to deliver those superior returns. When I look at what it is that we do as a business and how we need to impact society, many of you might not be aware, but on average, Africans are spending about 50 to 60% of their disposable income on food. So just to give comparison, that was the amount that maybe an average consumer in the US was spending in food 150 years ago, right? In the 1870s after the Civil War, 52% of US disposable income was going into food. Today, that number is 7%. Of course, you can adjust for inflation that currently is plaguing most of its markets. But 7%, that's such a low number. When you go to that country, you see the 93% in entertainment, in healthcare, in all the other things that are happening in that economy. And the key thing is that for Africa, we cannot unlock ourselves from that if the percentage of money that we continue spending on food is increasing because of inflation, because of all these other things. And the key thing is that there's something that we need to break around the food value chain so that people can then spend less on that and focus more on some of the suppressed needs that they have. So the way we see ourselves as Twiga is looking at the entire food supply chain and saying, what are some of the things that we need to change as far as the efficiency of food production is concerned? And if we do that, how do we then pass that on in terms of lower food prices and hopefully unlocking other funds that the people then can spend on other suppressed needs? So when I look at the journey that we've had to walk, and I'll give you just a quick example around a tomato, right? A tomato in California, a ton of tomatoes in California costs $100, right? California is one of the wealthiest geographies in the world, if you're to put it that way. In Kenya, a ton of tomatoes costs $400. So we're paying 4 times the wholesale price in California. The same ton of tomatoes in Kinshasa costs $2,500. So they're paying 25 times. And this is one of the poorest cities that you have in the world. And what you find is that unless you fix that, which is very, very basic, then food that is, money that is earned just goes to feeding yourself. And a country cannot develop from that perspective. So when I talked about infrastructure deficiency, I looked at, for example, Kenya. And what you find is that across Africa, because the markets are so broken, everybody's talking about smallholder farmers. But when you fly into Europe, any city into Europe, the last 15, 20 minutes of your flight, you're flying over big farms, right? You know, you always see that when you look outside the window. There's a lot of efficient production that you have in those spaces. So for us, one of the things was, why don't we build our own commercial farm and see whether we're able to lower the cost of food? And we did that. And the thing is that now we're having productivity that is 3-4x the average farmer in the country. And now we're able to sell at a much, much lower price than what you're able to get in the market. So, and this is how I consider us having impact. And that's a good thing about our kind of business, where doing good is good business. And the more you're successful, then the more you're lifting people out of poverty. And being able to do that profitably is such a joy.
Fantastic, and a great example of true innovation and doing things differently, doing things more effectively, more efficiently. And that's the only way we're ever going to reach the SDGs. I'm going to open up in a minute to the audience for questions. I think we'll have mics that go around. But before that, Honorable Minister, I wanted to come back to you one more time. Peter talked about infrastructure. And I know that infrastructure financing is also part of the plans that you were discussing earlier. You talked about de-risking. We've been hearing about blended finance these last days. Would you like to comment on how to get encourage blended finance structures and get the public and private sector to invest together, particularly around infrastructure, or what some of the challenges are around infrastructure investments? Otherwise, we'll go to the audience.
Well, just if I may, because I actually have a 2 p.m. meeting, so I would like to respond to you, and please forgive me because I have to leave. But I think my colleague, Dr. Sarah Alade, is also in the meeting room there today, and she might support with any Nigeria-specific questions. It is important for us to continue to find different innovative financing instruments. There is no one answer that does it right, depending on the type of business. We have ourselves, even as government, been exploring blended finance, and certainly it will be one of the best options that small businesses as well as medium-sized businesses should consider. As government, we have invested alongside private sector through PPP instruments, but we've also invested using a combination of different sources of financing. In some cases, concessional financing combined with commercial financing, just to be able to raise the right size of funds. We have a huge infrastructure gap in our country. And it is clear that government financing cannot fund the gap that we have. So we have to do everything that we can to enable businesses that show interest to actually bring in their resources and invest alongside government in infrastructure. And it is infrastructure that is required. As Peter said, you come in as a business, you have to provide your own infrastructure. For example, you have to provide your own light to be able to run your business. So it's important that governments that have deficiencies in some of our countries concentrate on building out infrastructure in partnership with the private sector so that businesses will have a better environment to operate on, a better environment in terms of power, in terms of access and transportation of goods and services across the markets. So again, apologies, I really have to leave. I have a 2 o'clock virtual meeting also that I have to sign off and join.
Thank you so much for being here with us. We greatly appreciate it. If we can give a quick round of applause. Thank you. And just to say, in Geneva, of course, a lot of the international organizations and private sector players are very involved in innovative finance and working closely with countries around the world, and particularly developing countries, on some of these structures, blended finance structures and other innovative financing instruments. We've seen a lot of developments coming out of Switzerland in that regard. But now I'd like to turn to Ghana. We actually have the CEO of the Investment Promotion Center here with us, and I'd like to offer you the microphone.
Thank you very much. Thank you. Good afternoon to all of you. I would have thought that when the African conversation came up, this room would have been full. But that's not the case. And I'll tell you why. I'll speak a little bit about the African continent because I take a totally different perspective for them. Now in government, I used to be purely private sector, in the worst place that you can be as an investment banker. Now Africa, the continent of Africa, I mean, we've had all the challenges, but the challenges are definitely opportunities. They are opportunities for investors. Now, why do I say so? This is a continent that has not less than 40% of the world's mineral resources. 90% of the platinum, 90% of the cobalt, 90% of the chromium, 75% of the coltan, over 50% of the gold, not to mention bauxite, chromium, oil and gas, diamonds. And yet, it's the continent of the poorest people. And that is a narrative that we've held for so long. I remember in March 2000, The Economist, yes, it was March 2000, put on the Africa, the dark continent. By 2011, it had changed that conversation to Africa rising, and the continent is still rising. But the importance of letting you know all this is that I think we need to change the narration. The world needs to change that narration. It's not just about Africa being left to its own devices. Why do I say so? Currently, a population of 1.4 billion people has 65% of the world's remaining arable land. I sat through the agricultural conversation here. Africa was mentioned 3 times. But it has 65% of the world's remaining arable land. 10% of the renewable water sources in the land are in Africa. So obviously, Africa has a challenge, but it's an opportunity. And when we speak about SDGs, I can assure you, being an African, working in Africa, Africa's developmental agendas are all expressed in the SDGs. So for us, talking about SDGs is nothing new. That is what we've lived for. Access to education, clean water, better respect for gender, and all that has always been with us. It's nothing new. But the financing has always been a problem. Let me throw a few statistics to you. I'm told that when you look at returns on foreign direct investment, Africa tops with 6.5% averagely. Next to it is Latin America at 6.2%. The developed countries have not more than 6%. Yet Africa has less than 5% of global FDI. The real reason why I'm saying this to you is, today, Africa's population of 1.4 million, by 2050, will be 2.6 billion people. It will be 1/4 of the world's population. But it will have a demography that is critically important, because 60% of that population will be under the age of 30%. It means 2 things: a consumer market waiting to happen, and potentially the world's next supply of labor for growth. And so for any business who might look at Africa today and says, well, too many risks, too many problems, that's not a place to go, in the future you'd have missed the plot, because it's going to happen in Africa. By the year 2100, Africa will be 1/3 of the world's population. You can't ignore it. You need to have a look at it now, because it's resource rich. The cost to entry, the barriers to entry are perhaps high, but the cost to entry is lower. It's much, much lower. Europe is maxed out in return. America is maxed out in return. Africa, you can make the returns. So even as we speak about the challenges, for me, there are real opportunities that you can leverage for growth elsewhere. The minister spoke about the Africa Continental Free Trade Area. It's currently the largest tariff-free market since the WTO. And if investors are to invest in production on the continent, you have access to that 1.4 billion people. Where else in the world would you get that but in Africa? So I think that the African narration has not got the right perspectives. And perchance, it's all due to a lack of transparent information, which has also fed into credibility. I mean, I was speaking to a friend here who mentioned to me that, well, yes, but there's a lot of corruption from Africa. And I told him, name the top 5 corruption cases in the world today. None of them are from Africa. So we need to get the perspectives right. We need to get the story right. Africa is not the dark continent. And I just came back from Norway, where we had the Nordic Africa Business Summit. And it became very clear that in this era where we are facing challenges with energy, Africa still stands possible as the region to supply the world with the next clean energy. Firstly, because of our oil, gas deposits that we have, our water bodies, and the fact that we still have 25% of the world's remaining woodland, forest land, trees. Africa contributes less than 4% to global emissions. Yet the top 5 countries suffering from climate change are in Africa. The Congo Basin alone can act as a sink for 8% of those emissions, not to mention the rest of the continent. So I think that the perspectives needs to be gotten right. In Ghana, we have built our case on a national development strategy for SDGs. And Ghana was the first country globally to benchmark its budget to the SDGs to ensure that there's an alignment between the SDGs. What has happened in Africa, though, is over the period, the terminology SDGs, which was a development from the Millennium Development Goals, etc., has created this impression that these are highfalutin terms from governments, when really they are opportunities for private sector. And so for us, we've benchmarked in our budget, and we have come out with a constructive plan called the Ghana Cares project, which happened right after the COVID pandemic, which is Ghana Cares means the COVID alleviation and revitalization of enterprises support program. Now that has clearly mapped out investment opportunities for private sector. But perhaps the more credible development is the work we've done with UNDP, coming out with the SDG investment roadmap, which actually brings clearly to the front of the private sector opportunities in SDGs that have very attractive returns. Some of them have IRRs of 50% and above, that before would have been looked over. Additionally, we work with UNDP and other partners for what we call the country financing roadmap, which assists countries achieve real financing mixes for their SDG programs. And I think I'll leave it here, but for me, you can't do all these things without coming to Ghana first. This is the country in the middle of the world. We are the only country who can claim to be in the center of the world on latitude 0 and longitude 0. And we have a 360 view of the world and everything. So I invite you all to come to Ghana.
Thank you. Thank you. And exactly, this session is all about opportunities. And to be honest, I hope that next year we can do this in plenary, not in a breakout, so that everyone can hear the powerful things that you all have been saying today. It's really incredible. So we're a bit short on the Q&A. I'm going to take a number of questions together before I turn to the panelists to answer them. And I saw you first in the back here, and then you over here. And please keep your questions to questions and keep them short. Thank you.
Sorry, I think.
It's okay.
It's
Go
okay.
ahead.
All
You
right.
have the mic. Sorry.
Good afternoon, Martin Leby, International Trade Center. Thank you for this very interesting panel. I have a question to the two founders here. I'd like to know what is your advice to startup founders who are in tier 2 markets, so not in the regions, but in outside of the big 4? And that's the first question. The second question, as I'm at it, is what are your plans to scale beyond the borders of Africa?
Okay, we will come back to you. I'm going to take a few questions. We have the gentleman back there.
Thank you very much. I'd like to know your view how to address also Francophone Africa. I'm working in Anglophone Africa, teaching in Nigeria, but also I see the gap between what you mentioned are all Anglophone African countries, and Francophone need the same approach, but I see a different culture and different background. So what is your recipe for that? And the second question is this, how do you see the possibility for African banks to further develop? There was a lot of development in the last few years, but still, I think the banking sector is a question because let's say many of our partners, for example, they say, yeah, we don't get the money, the capital from African banks. You have to go to Europe or the US. So what's wrong with that?
Thank you. Okay, we had a lady over here had her hand up, and then you, and then we'll turn to the panelists.
Hi, thank you so much for the panel talk. Should I stand up? So my question, actually, you've mentioned how we, as Westerns, we all assume Africa is risky, etc. But as a founder or as someone who works in Africa, what would you say should a Western investor look into when, for example, I have a couple of thousands and I want to invest in an African female founder? You mentioned that you were required to do the FCPA audit. What are your thoughts? What should we be looking at?
Great, thank you. And then we have the question here.
Yeah, thank you very much. Yeah, thank you very much. No, so like. Yeah, my question is a short question for our friend sitting in the middle, because he raised intellectual properties, and I'm working also on intellectual properties. And I can tell you shortly how I became also expert on investment.
The question, please.
Yes.
Thank you.
It is the question, please. It is concise, because IP, it's on behalf of law and management. And when sometimes I'm seeing as an IP, the they told me other investing promoters, and like that, and became also working on the investment. But if you are really investing in intellectual properties, patents, or trademarks, or copyright, let me know how about it, because in African continent, and if it is about investment, we can talk, and we are here. Thank you very much.
Great. Okay. Why don't I turn ladies first?
Thank you. Thank you for the questions. I hope I wrote them all down. All right, so advice for founders who are in tier 2 markets. I think it's okay. I think there's some markets in Africa that are really good for incubation. Rwanda is one of them. It's a smaller market. You can get to, you can prove out your product market fit and then go outside of Rwanda to the neighboring countries to scale. Alternatively, what I'm finding, or at least what MarketForce has as a growth strategy when we go into a new market, we always look first to see whether there's an incumbent who's smaller that we can acquire. So we're seeing a lot of consolidation happening in this space, and I think that will continue to happen. And so for founders who are in tier 2 markets, build a good business, tap into the angel networks within that market, because they bring more than just the capital. They help you with the relationships that they've built in a lifetime. And then start scoping out. You can even shop to see whether, if you don't want to expand or you don't have the capital to expand outside of your market, then being acquired is a good option too. The second question was expansion plans. We do have expansion plans. We're currently in 5 markets. We want to be in 15 markets by 2025. We're in East and West Africa. We're looking to expand into Central and Southern Africa during that time as well. There was a question around Francophone Africa, how we're thinking about Francophone Africa. I think for us, we have looked at Anglophone Africa. It's the same sort of legal structures across Anglophone Africa. We haven't had to navigate the cultural and language barriers. I think there's a great opportunity in Francophone Africa that will probably be after 2025 for us, if I'm going to be honest. There was a question here around African banks. I'm going to assume you were talking about why African banks are not funding startups, not how African banks are performing overall. I think it's a risk. There isn't a strong enough incentive to take the risk in startups when they can invest or put their money towards bonds and real estate. I think there can be incentive structures built there so that there's more allocation towards higher risk, higher return opportunities on the continent. I think there is also still a great opportunity for non-sexy VC investments. So organizations that deal with beauty or food processing that are also quite more fit for purpose for African banks, and they bring solid returns. So overall, more capital flowing into the private sector is good for the entire continent. There was a question around what to look for when looking to invest. This is assuming you're not based on the continent. Well, there are different approaches. You could decide to hire someone locally who will help you identify good opportunities and vet them and structure investment. That's one option. Another option would be to find organizations who have a similar thesis to yours, and you can co-invest. I think co-investing, especially when you're looking into new markets, is smart. Depending on how much money you're looking to mobilize, if it's your own private capital, I'd say get involved with angel networks. There are now angel networks that are purely for women if you're looking at women investments. And so they go out and find opportunities to invest that are women-led, or also looking at females as the primary consumer. I will leave the IP for you. I felt it was very specific.
Okay, so thanks. I'm just going to build on what has been shared. I think the first thing is it's very clear that Africa is not short of opportunity. I mean, there's lots of opportunity, but not everyone can execute against the opportunity. So, and the key thing here is that, and that's the piece that many startups need to really focus on, is how do I build the opportunity to execute against this? Now, when I look at, for example, the consumer space, $700 billion of consumer spend on the continent today, right? But the key thing is that there's a context to which you access that opportunity. And I think the key thing is that you need to be alive to that context and how you then are able to execute against that. And what you find is that there are certain startups that are figuring that out. So what I would say is that, if you're a startup in a second-tier market and you want to access capital, the key thing is that figure out what is my context within the opportunity that I'm executing, and how do I go about in developing a strategy that I can then execute and be able to showcase that I can actually access what it is that I have called out as an opportunity. So I think that's what I would advise for anyone who's actually building a startup in a smaller market. Second thing is that scaling outside of Africa, what you find is that the opportunity that we are solving as a Trigger is an opportunity around where you have inefficient retail, informal retail. So you find that in markets like Europe, the US, in many Western markets, people are transitioning towards convenience. So already there's like a foundational efficiency that's already built into retail. So everyone's really investing in that convenience piece. But what you find is that places like Africa, Asia, Latin America, we still have a huge informal retail segment. So those opportunities still abound. What we have done is that we want to focus first on the African continent because the opportunity is significant. You go look at a market like DRC, right, Kinshasa. You might then say, oh, Kinshasa, there isn't much opportunity there. But all the onions you consume in Kinshasa are from the Netherlands. So why not produce onions locally? Most of the tomato paste is coming from Spain. Why not produce that locally? So what you find is that there is a lot of opportunity as you move into some of these markets just by fixing very basic problems. And that's why you find that, in Africa, if you're focusing on food, healthcare, transportation, it is an enormous opportunity because these are very, very basic problems that could generate quite a huge return just due to the inefficiency that you have in the current way of working. Francophone Africa, definitely a huge opportunity. There's work that we're doing right now in some West African markets, still exploratory. But for me, what has been surprising is the level of importation of very basic food items, which means that there's huge opportunity just in terms of import substitution. Just thinking about things in a very, very basic way, then you start opening up a very, very significant opportunity. So I think that there's still a lot of opportunity in Francophone West Africa. But again, what I find is that, there's a lot of fancy things that one can do with a business. I think Africa right now is focused on the base, right? A lot of the people are sitting at the bottom of a pyramid. If you're able to just solve a problem for that particular population segment, then you're talking about billions of dollars of opportunity. So again, it's about thinking very simply, but at scale. Advice to African banks. I think African banks have gotten used to working with a certain demographic. And what you're finding is that the risk appetite, once they get into the lower segment of a population, is really not there. So one of the things that I'm finding is that fintechs that are coming up are bridging that gap. Because now you're able to use data, you're able to use analytics to quantify risk. You don't need to always hold on to a piece of land or a building so that you can advance somebody credit. And I want to give an example of Trigger. We started advancing microcredit to retailers about a year and a half ago. And when I look at between January this year and now, our loan book has actually grown 30x. In terms of how much we're lending to the micro retailers. Our non-performing loans have dropped from 1.9% to 1.1% as you're having that exponential growth. Now, most banks have a non-performing loan portfolio of maybe 4-5%. So what you find is that doing business with some of these unbanked folks is less risky than some of the big projects that banks are looking at. And I think the key thing is that they just need the tools to access this type of market. But they've gotten used to working in this space. And I think in this space that is at the bottom, there'll be companies that will come and take over that space. And hopefully will get bought by these very banks in the future. In terms of risk mitigation, I'll not build on what has been said. I think the key thing is that just get involved in the angel networks. There's a lot of energy in that space and a lot of people who are actually investing in companies. In terms of intellectual property, I think the key thing is that, and what I find on the continent is, yes, you can actually have the IP, but what I'm finding to even be more valuable is finding people who can then execute against that IP in the market. So there's also an execution element to it. So because what I find is that there's a lot of IPs that are being registered, for novel ways of doing business. But the key thing is that when you take that IP and take it into the market, does it generate value? So what I would say is that there's an element around intellectual property and execution capability, and you need to more or less marry those two so that then that particular entity or company can then materialize that IP into a return.
Thank you both. Unfortunately, we're almost out of time, and I wanted to have a chance to come back for 1 minute sort of closing comments from each of you. And since we're here at Building Bridges with the international community, the international organizations, private sector, public sector, NGOs, any thoughts that you would have for how these different players can help in encouraging more investment in Africa? So with that, who would like to go first? 1 minute, literally, we have 2 minutes left.
1 minute.
1 minute each.
Okay, I think in closing, context is king. I think in rooms like this, I want to see a lot more representation from the global south. I think the impact that you seek to see is in the global south, and the voices of people who are living there and working there is really valuable. Thank you.
I think what we'd want to see more of is ways in which we're able to quantify risk that create context for the opportunity, and that unlocks the funding. Because definitely, as we mentioned, there's huge opportunity on the continent. There's a lot that can get done, but I think a lot of folks are not able to get past the risk. And I think the key thing is that, there's innovative ways that we need to start thinking about, how do we then start encouraging more entrepreneurship, a way in which we're able to quantify the risk, mitigate the risk, and start accessing the opportunities that sit on the continent. But very, very excited about where this could lead. Thank you.
So thank you both. Obviously we've heard a lot today about opportunities in Africa, and not just for entrepreneurship, innovation, and investment, but also for impact. So thank you so much for being here with us, and thank you also to our guests from Ghana for your contributions to the discussion. And I think there's a break now, but thank you all for your questions, and hopefully you can still have a chance to catch them if you're lucky afterwards. Thank you.